Hi there, welcome to Kneppy Invest. It has been 2 months since I did the State of the Markets video. A lot has changed in the world, and I am much more bearish right now in terms of the economies and the markets. And even though I am a little bit more bearish, and when I say a little bit, I mean a lot more bearish, doesn't mean I am going all to cash right now, because I could be completely wrong and we could be at the bottom right now. I think it is highly likely or unlikely that we are. Now, the reason I wanted to do the State of the Markets video, uh, apart from it being the day before my birthday, is that we did see some really interesting stuff come out of the United States before the weekend in terms of not really inflation, but something else. And that something else is consumer sentiment came in at record lows. I'm not sure if it was record lows, but at least 40-year lows, maybe even longer than that, came in at 50.2. And this is really important, not only for the United States, not only for Australia, but also the world, because you don't want really low consumer sentiment, because consumers drive growth in economies. And we'll talk about that later in the video. But the very fact that we are near record lows or heading towards record lows in terms of consumer sentiment. So consumer sentiment never got this low during the GFC. In fact, last time we saw it near this low was way back in 1980. And around that time, we saw record inflation. One of the reasons why this is interesting, and we should pay attention to how consumer sentiment is going, apart from the effect it will have on the economies, and again, I'll talk about that later, is every single time you see a massive dip in consumer sentiment, what happens in the next year? We do see United States go into recession. That's those sort of the grey bars you see in this index of consumer sentiment. This is straight from the University of Michigan website. I don't think they've updated it because the numbers we're seeing here is closer to 60, not closer to 50. So this is not the updated University of Michigan index of consumer sentiment, but what you do see here is a correlation between significant drops in consumer sentiment and recessions in the future. Probably there has been some work done on this, but I do think there is a pretty good correlation between that. So I think it is highly likely, probably won't say highly likely, but I think there is a really good chance United States will go into recession in the next year. But not everyone thinks that way. In fact, Janet Yellen is a lot more bullish, and she doesn't understand why consumer sentiment is so abysmal. And I find this really amusing, how she cannot understand how consumer sentiment can be so bad right now with massive inflation, huge inflation, pricing or real wages going down each and every day as inflation keeps on remaining high. I don't understand how she can find this confusing. So she actually said here, when you look at opinion polls, when you see what households have to say, it is amazing how pessimistic they are, given that we have about the strongest labour market we've had in the entire post-war period. Now, I can tell you, I don't care about employment levels. I don't care about the labour market. I have a job. What I care about is that prices are increasing and my real wages are going down. And if my real wages are going down, I will be spending less in the future. So it just astounds me that someone in this level, and she's highly thought of, can find it bizarrely confusing why consumer sentiment has dropped to historic levels. She actually acknowledges that inflation is clearly a problem. So she can't see that link between inflation and real wages and the fact that consumer sentiment has dropped like a rock over the past few months. And this, I think, is a problem moving forward, that if people in power like Janet Yellen just don't understand the effects of inflation, the effects of lowering real wages have on economies, then we are heading for even worse times than we are even imagining right now. They need to get a handle on this, and a handle on this fairly quickly. Not only a handle on it, an understanding, a basic understanding on what's driving these drops in consumer sentiment. One of the things that's dropping consumer sentiment right now is expected changes in real income during the next year. And I've already talked about this. If I don't get a pay rise in the future, the next few months, then my real wages will continue to go down. And if I have less pay in real terms coming into my wallet, I am going to spend less. And this is the expectations of people out there right now. We are seeing expected change in real income to drop, and we are moving towards record lows as well in this particular data set. But why is consumer sentiment so important? Does it really drive the economy? Well, yes, actually it does. And this is a percentage of private consumption to GDP by country. Now, some countries are more highly affected by changes in consumer sentiment than others. Australia, 50.7% of our GDP is through private consumption. So if you have decreasing consumer sentiment, consumers will start to spend less and less and less. So that's how we go into a recession. Fortunately, during GFC, we were saved by the mining boom, and there is potential we might be saved again by mining over the next year. Now, for instance, China only has a 38.5% of the GDP is through private consumption. So that is actually fairly low. But when you look at the United States, 68.2% of their GDP is derived because of private consumption. So again, consumer sentiment is highly important when it comes to United States. I think United Kingdom have a very similar level than that. And it's highly important for Venezuela. 100.5% of their GDP is because of private consumption. So just through these numbers, you can see how important consumer sentiment is to the state of the economy in the future. Now, before we have a look at the updated XGO, let's go back to the last time I did a Say the Markets video. And according to this, it was March the 18th. And that's actually 3 months ago. March, April, May, June. Yeah, 3 months ago. I thought it was 2 months ago. But according to this, it was 3 months ago. And on March 18, I was a lot more bullish than I am now. And probably I was during February as well, because the SGO at this point in time was 7,294.4. But more importantly, we had just seen a higher low, and there was potential we were going to see a higher high. So even though it was looking a little bit bearish over the first 2 months of the year, March was actually looking up for the XJO, and there was potential we could have seen the market keep on rising. In fact, we actually did see it keep on rising from here. Actually, in actual fact, it went all the way up to 7,600, and that was a triple top we did see. I'll talk about that in the next slide. But so at this point in time, I was a little bit more bullish than I am now, but things have turned for the worse over the past 3 months, particularly over the past month, maybe even 3 weeks. Things have really turned for the worse, not only in Australia, but also overseas. So I mentioned in that previous slide that after March 18, we did actually rise quite quickly from that level all the way to a high of 7,600, which was a triple top. That's that represented by that horizontal blue line. Triple tops are not good things. So a lot of selling pressure as soon as the XJO got up there. And as soon as we did reach that level, we saw a lot of selling coming into the markets. And we have seen the XGO move below 7,000. It's now sitting at 6,932, right on a level of support. And if we do see the XGO fall below this level of support, and there is a really good chance that we will see this on June the 14th, my birthday, because we saw the American markets down big because of the consumer sentiment, and probably more because of the inflation, higher inflation than expected. There is a chance we might move to the next level of support, which is just below 6,850. It all remains to be seen if we do that, if there is a bit of selling on the Australian markets tomorrow, because we have another overseas market tonight, and it'll be interesting to see how the overseas market reacts. But the XGO is moving down. We've had 2 big down days in a row. So you might be saying this is heading towards being oversold. And once the market does become oversold, we might see a little bit of buying pressure come in. But if it does fall below around about 6,850, definitely below 6,750, that will be the bearish move. At this point in time, I'm not willing to confirm that the XGO is in a bear market. well, not in a bear market, is in a downtrend right now, because if you do look over the past, say, 9 months or so, you could actually argue that the XSO is going sideways. But when we look at some of the other indices around the world, you can't really say that, particularly the American indices and even the small cap index indice, the XSO is definitely in a downtrend right now. So let's have a look at the Nasdaq. And before we have a look at the updated Nasdaq, just want to go back 3 months to March the 18th. And we had seen the Nasdaq bounce really nice off a level of support at around 13,000. The question was this a dead cat bounce, or was this a V-shaped recovery? I was not thinking this was a V-shaped recovery at that point in time. I was thinking more it was a bit of a relief rally or a dead cat bounce. So let's see how the Nasdaq has performed over the last 3 months. And not good is the answer to that. So after the last video on March the 18th, the Nasdaq kept on rallying all the way up to 15,200. So it looked like potentially that was a V-shaped recovery, but there was actually low volume on that rise. And you want high volume. You want really good volume when the market is rising in that potential V-shaped recovery, that dead cat bounce, because you want some, what's the good word for that? You want some conviction behind the increase in the Nasdaq. You want some conviction behind the buying. There wasn't any conviction. And when you see a lack of conviction, that is time to sell into the rally. So that's the opposite of buying into the dip. You sell into the rally. And if you've done that, you probably have done fairly well, because the Nasdaq has fallen below that support level at 13,000. So that support level has now become resistance, and it moved towards a support level at around about 11,800. And once it hit 11,800, we did see a little bit of a rebound, testing or tried to test that resistance level at 13,000. But over the last few days, it has fallen away quite sharply. And I think there is more to fall. Looking at this chart for the Nasdaq, how much further it has to fall, I have no idea. And no one out there has any idea how much further this has to fall. Maybe this is the bottom. Maybe 13,000 or 11,800 is the bottom for the Nasdaq right now. We just don't know. But at this point in time, it does look really bearish. And if I had to pick whether this moves lower or higher from here, I'd probably say it will more than likely move lower. And very similar story for the S&P 500, right on a support level, fairly strong support. Now, I wouldn't say strong support level, but that's the last time we did see a bounce off about 3,900. And you can see about a month ago when we did see the bounce off this level, there was about 3 or 4 days with a low wick on the candlestick. That's telling us there was a lot of buying coming in to push the S&P 500. So it's very important over the next few trading days, we see some more buying coming in to push the S&P 500. If we don't see buying, the S&P 500 will fall further from here. Now onto the Russell 2000. I do like to look at this, and this is very similar to the S&P 500. We had a resistance level, well, support level that became resistance. This has happened now twice since the start of the year. Actually, since the start of December. Since the start of the year, because there was a really strong support level at around about, say, 2,160, and that was broken in January this year. It tested it back in about March. Was that March? Yeah, late March. It tested that new resistance level, and once that test failed, we did see the Russell 2000 fall away quite sharply during April and into the start of May. Hit that support level at 1,720. Nice little bounce. But over the last few days, we have seen the Russell 2000 fall away quite sharply. And I think there is a good chance we will see this index go back to that 1,720 support level and maybe test it again or fall through it on some good volume, which would be on strength. And if it does fall through 17,000 or 1,720 on strength, that would be a fairly bearish move. Now let's have a look at the XSO, which is the ASX small cap index, and let's go back to March 18. Now, unlike the XGO, which wasn't really in an uptrend, downtrend at this point in time, quite neutral, the XSO was in a downtrend. There was a triple top. So the XGO at this point in time only had a double top. It would have the triple top reached after March 18. There was a good level of support at around 3,125, and the XSO had bounced off that level of support over the past 2 weeks and was moving up at this point in time. But because the index was in a downtrend, I think there would have been some negative sentiment, and more than likely this would have fallen from here. So let's have a look to see if the XSO has fallen from these levels. And last time we'd have a look, the XSO was at 3,281. Now onto the updated XSO, and forget that date. I just forgot to change the date. That should be the XSO Daily, June the 10th. And this is looking really bearish right now. So small cap companies are getting hammered on the ASX as we speak. Well, not as we speak, because it is a public holiday today. Not in Queensland, it's not. Most people are working, but the ASX is having a public holiday. So the XSO is, and small cap companies are not getting hammered as we speak, but they would have been if the market was open. But the XSO has fallen dramatically over the past few months, particularly from April, going or moving down from about 3,400 to a current level at around about 2,860. It has fallen through a nice little level of support at 2,940 on strength, 2 big down days on good volume as well. So I don't see why this wouldn't fall further from here. This is the sort of chart that if you were holding a company, you might want a bit of a relief rally, a bit of a dead cat bounce, but a very negative sentiment when it comes to small cap companies on the ASX right now. And the question is, do you sell now in anticipation of further falls, or are we moving towards the low? And that is probably one of the hardest decisions we have to make as investors. Now to the bond markets, and this is one of my favorite graphs, which is the 10-year US bond yields, government bond yield, the greatest bull market of all time, which has lasted about 40 years. Now, don't forget, this is government bond yields. Now, bond yields are inversely related to bond prices. So if government bond yields are going down through time, that means bond prices have been going up through time. Hence why this has been described by some people as the greatest bull market of all time. But there is a relationship between government bond yields, particularly when they do start rising, and trouble in the equity markets, particularly on the Nasdaq. And if we go back through the past almost 20 years, we have seen on 4 occasions, now 5 occasions, where we have seen a correction in the Nasdaq, which has been preceded by rising government bond yields. We saw that in the mid-1990s. In fact, the bond yields rose from 5.5% to 8%, and that coincided with the Nasdaq correcting 16%. We also saw, leading up to the tech bubble burst, bond yields rising. It actually rose from about 4.5% to almost 7%, and then the tech bubble burst, and that's why government bond yields started falling again. And then in the 4 years preceding the GFC, government bond yields were rising at a fairly consistent rate. And then we had the GFC hit, and then governments or central banks around the world lowered interest rates. That's why we saw government bond yields fall. And then during the second half of 2018, we saw government bond yields rising. We saw, particularly the United States, raising interest rates. And that coincided with a time that the Nasdaq corrected 17%. And over the past, so we'll say year or so, we have started to see government bond yields rising at a really fantastic rate. And it's no coincidence that we are seeing the Nasdaq sell off, because the Nasdaq is going to be the most affected index out there, because it is tech heavy, because those unprofitable tech companies are going to be the biggest company, well, not the biggest companies, the most likely companies hit the hardest. And we have seen some of those unprofitable tech companies fall in valuation by 80 or 90%. And the reason they've fallen by 80 or 90% is because the government bond yields have been rising over the past year or so. The question is, will this rising bond yield environment continue? And that's the most important thing. If we start to see government bond yields falling, and falling quite quickly, that could be beneficial to tech companies. So keep your eye on government bond yields, particularly the US 10 years. That's just because that's the one I keep my eye on. And if you do see a shift in sentiment, if you do see the government bond yields start falling, government prices start rising, that could be the time to get back into tech companies. And the last thing I want to show you is the Australian 10-year government bonds. And just like the American government bonds, this has been falling. The yields have been falling through time, so prices have been rising through time. In fact, they've fallen, the government bond yields, have fallen from 16.5% way back in early 1980s to a low of about, or just lower than 1% during 2020. But you can just see how rapidly the Australian 10-year government bonds have been rising over the past 6 to 9 months. And right now, they're nearly at 4%. And the last time the government bonds were this high, the yields were this high, was way back in 2015, 2016. So we are at about a 5 to 6 year high when it comes to Australian 10-year government bonds. That's all I have for this, the state of the markets video. I am much more bearish right now. But even though I am bearish, I can see a number of scenarios playing out in the future. So even though I'm bearish, I'm not confident. So it's really funny because I do read a lot of tweets, follow a lot of people, listen to a lot of podcasts, and so many people are confident about what they think is going to happen. I don't have that confidence. I see multitude of possible scenarios in the future happening, some really bad, some not so bad, some actually pretty good. I have no idea which scenario will play out in the long run. And that's why right now is really fascinating, because I think we are going to learn a lot about humanity over the next few months, maybe the next few years, on how we react to what's happening in the world right now, particularly if we go into a period of stagflation. So that is one of the worst case scenarios. I do see that as a possibility, not a high possibility, but definitely a possibility of a future world we might be living in the next few years. So if you do have any thoughts about what I talk about in this video, just leave a comment in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.